Episode 181 of Futures Radio Show, sponsored by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world effectively manage risk. For access to free educational tools and resources for the active individual trader, please visit activetrader.cmegroup.com.
Every day, traders and investors dive in to tackle the ever-changing markets to find opportunity. Futures Radio Show is your number one source for answers to the questions that all market participants want to ask. Veteran futures trader Anthony Crudele sits down with the most influential leaders and top traders in the industry. Now, here's your host, Anthony Crudele.
Hey everyone, before we get started today, I want to thank our sponsors. CME Group, Trading Technologies, RJO Futures, and Top Step Trader. Now today I spoke with Rainer Tu, independent trader and founder of Trading with Rainer. Today Rainer and I had an enjoyable conversation about how he got his start in trading and how his time in the military helped his trading and his life. We discussed why Rainer decided to become a systematic trend follower, and he explains how he executes his strategy. We talked about the common reasons traders fail and how to fix these issues. Rainer explains why it's so important to choose a strategy that fits your personality and goals, and explains how retail traders have some disadvantages to the pros and how they can level the playing field. As usual, thank you all for listening, and please enjoy this episode. Rainer, welcome to the show.
Hi, Anthony. Thank you for having me on this episode.
It's great to speak with you today. Now, I've been following you on Twitter for a long time, so it's great to hear the voice behind the Twitter feed. And we have a lot of great things to talk about today. But before we begin, tell us how you got your start in the industry.
Okay, so I guess it started sometime back when I was in the army, right? Because I'm from Singapore. Every guy in Singapore needs to serve the army for a couple of years. So while in the army, I was serving national service, and I had some free time on my hands. And at this point in time, I was thinking, what am I going to do with my life, right? So at that point in time, it was around the 07, 08 financial crisis, and that's where I kind of, got alerted to, hey, there's something called the stock markets, right? So that's where, I learned more about the financial markets, started reading books on it. And since that kind of interests me, I took up a degree in banking and finance, which was, I think, the closest thing to the markets. And then one fine day, while in school, a broker came down, organized a trading competition. And I thought to myself, hey, why not have a go at it and see how I fare? And obviously, the first time I traded, so on a demo, and didn't do well. I lost it all. And that's where I would say it officially began for me to the world of trading, right? Like, what this is all about, how traders do it. And, that's pretty much how I got started.
Do you think that your military training helped you as a trader?
Yes, I would say so. I would say military training helped me not only as a trader, but in all aspects of my life, I would say generally. Would you like me to talk more about it?
Yeah, absolutely.
Okay, so maybe just a little background, right? So I was enlisted into 1st Commando Battalion in the Army days. So it's for those of you who are unaware, it's basically so-called the elite for those people serving national service in Singapore for the 2-year stint that we do. So part of the elite, right, it's where you kind of, have to adopt the mindset that anything can be done, right? There's really no such thing as failure, but only feedback. So we are basically when war comes, right, we are put in the situation where you either complete the mission or you are pretty much gone. That's it. So that is our only two options. Either you get the job done or you're gone. Gone as in, you leave this world. So that is the type of mission that we pretty much do in wartime. And so that's the kind of environment that I was trained in, right, where, you really have to go out there, be the best, succeed. And that's where, discipline and all the stuff comes into play. Yeah. So basically, if you are around people who are always striving to be the best, no matter how badly you do not want to be like them, it's pretty darn difficult to not be influenced, because I think there's a very famous quote that says that you're basically the average of the 5 people that you're around with. So, and that's really true. And that's pretty much how, military shaped me to be, disciplined. And as you know, right, trading is all about discipline, right? Managing your emotions, your psychology, right? Knowing how to keep moving forward even though, right, times are bad for your trading, for your career or whatsoever, and knowing to adapt and continuously improve yourself as a person.
Oh, I love that. I really do. That's very interesting to me. Now, I already know that you're a technical trader from your Twitter account and your website. And even last night, I sent you an email. I said, hey, Rainer, are you interested in adding anything about this latest move that we're seeing in the markets? And you said to me, nope, Anthony, I just trade my technicals, and that's all that matters to me. And I'm like, I love that, man. He's sticking to his guns. He's very disciplined. And you're not just coming on the show to talk about a move in the market, just to talk about it. So I really appreciate that. So can you tell us a little bit about your technical strategy?
Sure. I pretty much right now I'm more of a trend follower, right? A swing and position trader, if you really want to kind of categorize it. So a swing trader is typically a trader that tries to capture a single swing in the markets. It could be on a 4-hour or daily time frame. Whereas a position trader, like a trend follower, tries to ride trends till it ends, right? They say the trend is your friend. You ride it till it ends. But I guess trend can be really general at times because it really depends on the time frame that you are trading or looking at. So for me, when I trade trends, I like to trade the longer term trends, right? So when I trade trends, I enter off the daily time frames, and my trades, if it goes in my favor, I can hold it for months to even years. If I'm wrong, I could be out in hours or just a couple of days. Yeah, that's generally my trading approach.
Yeah, I've had several trend followers on this show, from Jerry Parker, Larry Tenerelli, Michael Melosinos, and a few others. And it always seems when I speak to you guys like you guys have a very simple process, but it takes a great discipline to execute. I mean, obviously, I think anything in this industry takes discipline to execute. But for me, I think it takes an even greater discipline because of the time in between waiting for these trades and then holding these trades for a long duration. I'm not built like that, Rainer. I'm much more of a short-term guy. But talk to us about how you execute your trend following strategy. And if you could also give us a trade example.
Okay, sure. So let's talk about systematic trend following. So I trade a systematic trend following strategy, and it's pretty simple. It's actually a breakout trading strategy. I think it's something that is very common among trend followers. I would say the core idea is basically I trade across different markets. So when I mean different markets, I trade the forex market, the indices, the bonds, the commodities, soft commodities, metals, and stuff like that. So I typically have a trade in these 5 different sectors. Number 1 is the FX. Number 2 is the indices. Then you have a soft commodities, hard commodities, followed by bonds. So these are 5 sectors and about 10 markets within each of these 5 sectors. So the strategy is actually very simple, and there's really nothing magical about it. I simply trade the 200-day breakout. If the market breaks out, I go long, and I have a stop loss in place, right? So if the market goes in my favor, I just simply trail my stop loss as it moves in my favor. If it's a false breakout where it just breaks out of 200-day and reverse hits my stops, I'm out of the trade. So I guess the core idea behind this is that you just never know what's going to happen, right? Some trades are just going to be huge monster winners. Like, for example, right, for the last few years, right, the S&P, the stock market has just been bullish, and no one knows, right, how far it would go. So you just simply, get long on the breakout and trail your stops. And it's only recently, I think it's to this morning, that it hit my stop loss and I finally got out of the trade for a few of those stock markets that I was in previously. So that's generally the core idea behind it, right? Just putting on the trades across the different sectors of the markets because you have no idea which is going to trend. And those that trend, you ride them. Those that didn't work out, you cut those losses. And that's pretty much the idea behind trend following.
Okay, so you use the 200-day moving average in your trend following strategy. But the question I have for you, because you talked about so many markets, how are you scanning them? Do you have a scan tool, an alert system, or are you just going chart by chart and waiting for them to get there and you're doing this all manually?
Okay, so just a quick mention is that I trade the 200-day breakout, right? It's not the 200-day moving average, but basically if the market closes the highest close over the last 200 days, that's my sort of entry trigger. It's not really a huge difference, but I just want to clarify that part. And yeah, back to your question, right? So all in all, I trade about 50 markets, 10 from each sector. And since it's on a daily time frame, you don't really need to spend a lot of time scanning the markets. For me personally, right now, I have this tool that I use with Army Broker. I had this programmer to help me kind of, program it. So every day I just need to download the end of day data. It will hit the scanner for me and kind of tell me which are the markets that have the signal that I'm looking for. So that's what I do right now. But honestly, previously to what I was doing, I was just manually scanning the markets, and it takes about like 15 minutes a day at most to just look through for the setups.
Now, what made you decide to use this strategy for your primary strategy?
I would say it kind of fits me well as my personality, because previously, while I was working at I'm not sure if I didn't mention is that I was working in a proprietary trading firm. Then, down there I was, scalping the markets, and I find that, I wanted to trade something that I could go into my ages, like, when I'm 50 or 60 years old. This is a strategy that I know can still work for me, because, you don't really need much time each day. So I went into this direction looking at a big picture, telling myself, if, 30, 40 years later, I still want to be trading, what is the kind of strategy that is likely to work for me, given my circumstance and given the odds that it is likely to work out still that many years later. And, trend following happened to be an answer to the question I was looking for.
Yeah, I love that about you, Rainer, is that you have great vision, and understanding that at an early age like you did, to find something that fits your personality, and looking at this business from a longer term perspective of what can you do now that you can also do 20, 30, 40, 50 years from when you started. And you're so disciplined in everything that you put out on Twitter, and you're very consistent, and I really appreciate that. And you post a lot of quotes on Twitter where you talk about why traders fail. What I'm curious about is, what do you think are the most common reasons that traders do fail? And I think even more importantly, how do you think that they can fix these issues?
Okay, so I would say there is a few reasons why traders fail. Maybe I can share a few with you. Number one is, I would say, for me personally, I feel that wrong expectations, because even though now we are in the information age where, information is readily available, there's a lot of conflicting information out there. Like, for example, you have traders thinking that, hey, how much do I need to trade for a living? Some says, hey, maybe $5,000 is enough. Some say, no, you need 10,000. Some say, no, you need 100,000. So this is where, traders just do not know what is real and what is not. So I think first and foremost is managing the expectations, to know that trading is a business. When you set up a business, say a mom and pop shop down the street, selling F&B, food and beverage, a restaurant or something like that, you don't expect to make money in the first year or even the first 2 or 3 years, right? You are pretty much, investing that time, effort, and capital to kind of, set up the business, buy the equipments, and see, the first 6 months, how the crowd is coming in. If it's not coming, maybe you have to, spend more on advertising. Maybe, the location isn't too good, you may want to shift elsewhere. So basically your first few years, you're basically, investing and not expecting a return. And I would say trading should be approached in a similar manner, where you don't expect to make money next month or the next 6 months. If you're new to trading, you should give it some time to kind of, spend time to develop that skill. And then from then on, once you kind of have the framework and foundation that is set for yourself, and only then can you look to scale up your trading later on. So I would say the first few years is more about setting up your business, right? Investing the time and effort into it, instead of, trying to, I don't know, take a 5,000 account and turn it into $1 million within the 6, 12 or 18 months. That is I wouldn't say it's not possible, because obviously people have done it, but the odds of you doing it is very, very slim. If not, you'll probably risk, blowing up a few accounts along the way. So yeah, I would say the first reason why traders fail is because they just can't manage their expectations correct, because there's just so much noise out there, based on social media, and whatnot. So yeah, that is one of the reasons why traders fail. A second reason that I can think of is, I'm also guilty myself, is that it's trading is not like 1 + 1 = 2. Trading is more of like 1 + 1. 30% of the time it could be 2. 70% of the time it could be 2.5, right? So there's really no fixed black and white answer to it. So where I think I spend a lot of time going around in circles is just jumping from one system to the next, because I didn't understand that you need to be consistent in your actions before you can get a consistent set of results. So I think what most traders face is that, I try a new strategy, 3 or 4 trades you make money, the next 4 or 5 trades I lose money, I pretty much declare that it doesn't work. Let me look for another thing, another strategy that could work out. And, you start this entire cycle all over again. And before you know it, right, years have passed and you pretty much have not really, accomplished anything that you hope to set out in the first place.
Yeah, I mean, you nailed this. You said basically, and I've said this before, and invest your time before you invest your capital. I mean, this business takes time to learn, and so many people nowadays can open up an account and within 24 hours be trading. and they haven't put any time in prior to that. And you know, Rainer, you found a strategy earlier on in your career that fit your personality. So I'm just wondering, what steps did you take, and also would you recommend for first-time traders to find a strategy that fits their personality?
Okay, so I guess first and foremost, I always ask is that, what is your goal as a trader? Do you want to, say, for example, make X amount each month, right, and work for yourself? Or maybe trading is as a form of, growing your wealth over time, where you still have your full-time job and you make X% a year. So once you have nailed down your goal as a trader, then you can choose the appropriate strategy to fit that goal. Because it doesn't make sense, say, for example, you want to make, say, a X amount each month or every 2 or 3 months, and then you take a trend following approach, because it doesn't work that way, because trend following is not meant to give you a fixed recurring income. It's more of a growing X% a year in the long run. Whereas, let's say you are someone who wants to grow your wealth for X% a year, and you end up, scalping and day trading the market. Again, it doesn't make sense, because day trading, scalping the market is meant for so-called a fixed, consistent income within a shorter period of time. So I guess first and foremost, the question is, what is your goal as a trader? And then finding the appropriate trading strategy to meet that goal of yours. Yeah, that's number one. The second thing is, whether do you have the time and commitment to trade that strategy? Maybe I know there's a lot of people that, I want to quit my full-time job. I want to trade full-time. I want to, be a full-time trader. But the thing is, you need to spend time learning how to be a day trader. I mean, if you have a full-time job, how are you going to find the time to be a day trader? Maybe you're going to stop working, give yourself, a 2-year break. You have enough funds to kind of, meet your this transition, or something along the line. So basically what I'm trying to say is that you need to not only find a strategy that meet your goal, that strategy must still meet the time and commitment that you have for trading. Yeah.
What's your advice to people out there that have full-time or part-time jobs that are trying to become traders? How should they start implementing trading into their schedule?
Okay, my advice to I'll say most traders is that, keep your day job. It gives you the comfort of having a fixed recurring income, and you don't have to rely on just trading as your only source of income. So with that said, of course, you can't go down into day trading or scalping, because those require, longer hours compared to swing trading or position trading. So my advice is to, keep your day job and learn how to swing trade the markets, maybe, on the 4-hour time frame, on the daily time frame, where your trades can last for a few days to a few weeks. Because those trades, you don't really need to monitor every tick in the market. You can just, set your stops, set your entry, and just monitor every few hours, right, and see how the trade goes and just manage it accordingly. And typically you don't need that much time compared to someone trading the lower time frame. So that is kind of my suggestion, right? You keep your day job, right, and learn how to, be a swing trader or a position trader, where this type of trading requirements isn't as time intensive compared to a shorter term trading style.
Yeah, no, that's great advice. Is keeping your day job, starting to trade on the longer term time frame. This is how you could start getting comfortable with markets, seeing how they move without having to make intraday decisions. Yeah, I think that's great advice for new traders on how to begin. Now, you talk about price action trading a lot in your stream, and you have some thoughts on this. Talk to us about that a little bit.
Okay, sure. So I think price action trading is more of understanding how the market moves. So let's say, based on my own trading experience, what I noticed is that the market isn't static, right? It tends to move from, I'm going to share with you a few principles that I pretty much live by. So the first one is that the market moves from a period of, low volatility to high volatility. So what I've seen recently in the stock markets, the S&P, the NASDAQ, is that, over the last few months, you notice the daily candles, the range of the candles are pretty small, right? So those are pretty much low volatility period. So one thing to note is that volatility and trend direction, they are not the same, right? The market could be in a low volatility environment, and the trend can still be higher, right? Because they are a different thing altogether. So usually in a low volatility environment, it doesn't last forever, right? Volatility will pick up and it would spike. So that is where you kind of, need to, at the back of your head, anticipate that is a possibility. So I guess one way you can, make use of this type of knowledge is that if the market has been in a range for a long period of time, volatility is shrinking, right? And, if it does break up, chances are that could be the real thing. And that is, the type of breakouts that you might want to consider taking, if such price action unfolds itself. I think there's a good quote by Paul Tudor Jones. I can't remember the exact quote, but he basically said something like, when the market when the range of the market is tight and volatility expand, don't fade the breakout when that happens, right? Something along that lines, and something that I pretty much agree with. Yeah, so that's the first principle that traders could adapt to, consider, or look at it and see if it holds for you. The other thing that I want to share is trends, right? Since I'm a trend follower, I trade trends. I want to talk about trends. Is that not all trends are created equal. I mean, traders talk about trends as higher highs, higher lows. Yeah, that's all fine and well. But when you look at trends, right, you want to kind of classify the type of trends you're trading. So for me personally, I like to trade strong trends. Like for example, the S&P, right, before the collapse over the last week, right, that's the kind of market I consider a strong trend because it has been holding up above the 20 period moving average, and it pretty much is a smooth sailing. So that's what I call a strong trend, either when the market goes parabolic or the pullback is very shallow, seldom exceeding the 20 MA. The second type of trend that I classify is what I call a healthy trend, is where the market tends to exhibit a deeper pullback. So it tends to pull back or find buying pressure at around the 50 period moving average. So you can imagine that a healthy trend, the pullback is much more cleaner, much more obvious to the naked eye compared to a strong trend. And the third type of trend that I classify is what I call a weak trend, where the market pulls back much deeper, usually back towards the 100 or 200 MA, or even sometimes retesting back, previous support or resistance. All right. So this is how I pretty much classify trends, because once you can break down trends into these three different categories, then you can have better ability to spot this type of trading setups. And I would say it should help your trades when you're trading trends, instead of just saying, oh, I trade with the trend. But trends, there are so many type and variety and nuances to trend. You really want to nail this down and ask yourself, what are the exact type of trends that you want to trade, you want to exploit, and then focus on that works best for you. So I think these are a few things that I want to share regarding price action. I mean, yeah, these are just my general take and thoughts on the market.
Yeah, so you mentioned classifying trends, and you also mentioned the 20 MA and the 50-day MA. So how are you identifying where to trail your stops when you're in these trends?
Okay, so there are a few ways to trail my stops. So for example, I can go back to the earlier I mentioned about systematic trend following. So how I trail my stops is I typically use the ATR. It's an average true range indicator. I think it's a very popular trend following indicator. So basically what it does is it tracks the volatility of the market. As volatility expands, the ATR value increase. So I just use a fixed ATR multiple and trail my stops with it. But again, that's not the only way to do it. You can use a moving average as well. That is fine. I've seen traders use parabolic SAR as well. So there are definitely different ways a trader can look to trail their stop loss. And one thing that I'm not sure if this is too relevant, but ever since I had that programmer to kind of do all this backtesting work, the key finding that I find in trend following, it isn't really the entries, isn't really the exits, because I've tried anywhere trading breakouts from 20 day, 40, 60, 80 until 200 days. I've tried trailing stops with a 2 ATR, 3, 4, 5 until 10 ATR. All of this pretty much make money in the long run, right? The key over here that kind of detect whether you'll make money or lose money in the long run from a trend following perspective is, number one, your risk management, and number two is the number of markets you're trading. Everything else regarding entries and exits, they are pretty much, I would say, secondary, right? The markets you're trading and your risk management is far more important than the other parameters. Yeah.
Okay, so you mentioned risk management. Obviously, I strongly agree with that. But the next thing you mentioned was determining how many markets you're in. And this is a question I think a lot of people have for trend followers, is if there's many markets that are fitting the category for you to take a trade, you only have so much capital. So how are you choosing which markets to go in?
Okay, so I'll just keep this towards a systematic trend following. So for systematic trend following, I don't apply any discretion to it. So let's say, for example, the Dow, the S&P, the Nasdaq, they all break up. I'm going to take all of these trades because I have already allocate this number of markets within the sector to trade. So let's say I have 10 indices within the sector. I have 10 bond markets within the bond sector, 10 forex markets in the forex sector. So pretty much if all of these signals happen, I'm just going to take all these trades along the way, right? Because if you think about this, right, all the backtesting work that has been done did not take into consideration correlation or trying to filter your setup based on discretion. All the research and testing has been done based on just numbers and stats. So going forward, right, the same approach will be applied, like how this strategy has been tested. So I don't try to pick and choose, right? Everything is systematic, and I just trade accordingly. Yeah, this is more systematic trend following. Whereas for say swing trading, discretionary swing trading, then that's that would be a different thing altogether.
Gotcha. So basically, going into all of your studies, looking at the markets that may fit into your criteria for a trend following trade, if you follow them, you've already allocated enough capital in that account to take that trade if it hits. If not, you're not even following it.
That's right. That's right.
Gotcha. Okay, great. Now, you do a lot to help retail traders, Rainer. And you mentioned how retail traders have some disadvantages compared to pros. But I do think that their disadvantages have been lessened over the years. I think technology has gotten better and the costs have come down substantially, at least from when I started to trade in the mid-90s. It felt like to be a pro back then, it was costing me a lot of money. And nowadays, it's much, much less. And we get access to tools that pros use nowadays that we weren't able to in the past. But there are still some disadvantages for retail traders. So what are some of the things that you believe retail traders can do to, let's call it, level the playing field?
Okay, so I would say, yeah, I do agree that technology portion, the spreads, the commission, it has come down drastically over the years. But one thing is I'm not sure if retail traders have considered is that, let's say you are a professional trader, maybe you work for a hedge fund. You are going to have a fixed salary no matter how good or well you do for that particular month, right? Because the structure or hedge fund fees are typically 220, where they charge a 2% management fee and a 20% cut of whatever profit that they make. So that's from a professional fund management standpoint. Whereas you as a retail trader, if you were to trade on your own, you have to kind of, make sure that your trading, no matter how good or bad you do, you pretty much want to have enough to put food on the table. Maybe one way you can go about doing it is to, set aside enough funds for the next couple of years to kind of, tide you through this period. Or maybe another way is that you can, get a job, right? So you're not reliant entirely on your trading. So you can kind of like feed yourself even if things don't go the way you want to in the particular month. So I would say that is one way to kind of level the playing field, because I would say most, even prop traders, I know when I used to be in prop trading, I have a fixed allowance each month, regardless of, whether I do well or bad for that month. So I would say that is something that you as a retail trader, you have to consider, because, the pros out there, those working for hedge funds, right, or maybe even the prop shops, they kind of have something fixed coming in every month. Whereas you as a retail trader, if you're on your own, right, if you don't do well that month, what now, right? How are you going to feed yourself? You kind of, need to answer that question first, or maybe, set aside some safety net funds or whatever to so-called level the playing field, so that you're not pretty much trading on that kind of level where, if something goes wrong, you're not out of the game, right? You can still survive and push forward.
Yeah, no, I mean, you have to treat it as a small business. I've been doing this my whole life. I've been an independent trader. And really, I think as an independent trader, although I am considered a professional because I've been a member of CME for all these years, I still probably classify in what a lot of people would call a retail trader, because I have to pay for everything myself. And even to this day, you have to balance it out. You need to be able to come in tomorrow, and that's so important. And a lot of retail traders that want to turn this into a full-time job, they go into it with the amount in their account, but you're so right, they're not really thinking about all the expenses along the way. They basically look at it as save money, get the amount of money in their account, and now that's what's going to they're going to be able to use to pay all of their bills. Well, I've got news for you from firsthand experience. After going through several trading accounts at the beginning, I got expensed out many times. I'd be sitting there looking at my account going, I'm breaking even, and I'm losing nothing but money because I had to pay for insurance, food, train, parking, everything else that you needed to do, charting. So you're so right, Rainer. You have to look at this as a business. You mentioned this many times today. Fantastic insight, Rainer. Really good. But we're not done yet. We have some rapid fire segment questions if you're ready for those.
Let's do it.
All right, everyone. Our rapid fire segment is sponsored by Trading Technologies. Trade the global markets from virtually anywhere with TT. They are the world's fastest commercially available futures trading platform. Create your account and try it now free at tryttnow.com. First question, Rainer. What trader has influenced your life the most and why?
Okay, this is honestly a tough question, but I would say Jesse Livermore, right? That the reason is because the book, right, Reminiscence of a Stock Operator, basically takes you the evolution of how someone who doesn't know a clue about trading, having so much success with trading, and then only to lose it all because you kind of, forgot your framework, the groundwork that made you successful in the first place. So it's pretty much an evolution of a trader, and it's a strong warning signal to any traders who's listening out there that, it's you against yourself. Yeah. So you have to always keep in check of yourself as a trader, because you could just lose it all one fine day. And I would say Jesse Livermore is someone that, even though I've never met him, right, his story, his personality, his character is pretty much how I see myself, and I tell myself I don't want to end up in that sorry state that he went through. Yeah.
How has your trading evolved over the years?
Okay, so pretty much I started off with trading shorter term time frames, right? Then I slowly move on to swing and position trading. Then I move on to systematic trend following. And right now, I pretty much am looking into more systematic strategies, like maybe systematic investing and using stats and maths to find an edge in the markets. Yep.
What's the number one resource you spend your time on?
Okay, number one resource, I would say for now, right, it has to be the ssrn.com, right? Because that is a social science research network website where there's a lot of research papers that traders or anyone can get their hands on and read through. And there's a lot of good stuff that's written out there by the academic professors. And that could actually, give you an insight to the markets and, to find so-called an edge out there. I would say that's a very good resource for traders who are, looking to find new ideas or strategies, or, to find something that could work out there in the future. Yeah.
What's your favorite book about trading or the markets?
My favorite would be Reminiscence of a Stock Operator.
What's your favorite movie or TV show about trading or the markets?
There's one documentary called Floored, Floored. So it's basically a documentary about trading back when, traders were trading still in the pit. And I'm not sure if it's still available. I think you can still source it, right? But again, right, it shows you the reality of trading, how traders from the pit, the success they had, and some of them couldn't make the transition to electronic trading. They basically, drop out. And again, that's a strong hit to me, right? That's the reality of trading. You've got to constantly adapt or die. Yeah.
What's the best piece of advice that you've received about trading or the markets?
Okay, so I would say you have to be consistent in your actions, and you have a chance of becoming a consistently profitable trader, right? You can be consistent in your actions and not be consistently profitable, but at least with that framework in mind, if you're consistent in your actions, but you're not profitable, you can always look back at your actions, review it, and then find ways to tweak it, right? Improve on it so that you can become a consistently profitable trader. So I would say that is very important, right? If you want to be a consistently profitable trader, you have to be consistent in your actions.
Now, if you can give a piece of advice to the new people interested in getting involved in trading, what would it be?
I would say, treat this as a business. Take your time to learn, right? Trading is not a get-rich-quick scheme where you put in $500 and turn it to a six-figure within a few short months, right? Look at the business around you. How do they fare, right? First couple of years, they may lose money. Then maybe the third year, hey, they break even. Fourth year, they do well. Fifth year, sixth year, they scale up. And next thing you know, right, 7, 8 years later, they're doing franchise, making millions of dollars and stuff like that. So your trading should be approached in that framework, within the expectations where, you're not trying to hit a home run. You're not trying to hit a jackpot, right? But rather take this as a skill to be learned, to be nurtured over the years. And then eventually, right, you will get what you hope for in trading, but not at the start, but in your later years.
If you weren't involved in the markets and trading, you'd be doing what?
As of right now, if I'm not involved in the markets, I'm pretty much, playing with my newborn daughter, my 2-year-old daughter. Okay, I'm blogging on my website and pretty much, interacting with people of different, I would say, industry. Yeah, I like to meet people in the marketing industry. I like to meet people in the psychological area. So basically, that's what I'll be doing.
Rainer, this was awesome. Thank you so much for coming on Futures Radio Show. Where can people find you on social media, Twitter, and give us a website to check out?
Okay, for people, you want to find me on Twitter, it's Rainer_Teo, right? That's my Twitter handle. For my website, you can look me up at tradingwithrainer.com.
Everyone, I highly recommend following Rainer on Twitter and going and checking out his website. As you could tell from hearing from him today, he really knows his stuff about markets and about trading, and he's just an all-around solid guy. Rainer, thank you again so much for taking the time to come out on Futures Radio Show today, and I look forward to having more conversations with you again in the future.
You're welcome, Anthony. Thank you for having me, and the pleasure is mine, my friend.
Thank you for listening to Futures Radio Show. If you have any questions or comments for myself or my guests, please visit futuresradioshow.com and sign up to be a premium member for free. If you enjoyed the show, don't forget to leave us a review on iTunes.